hedge fund manager lost $3.2 million last month. Not because the market crashed. Not because he picked the wrong stock. He lost it because his own AI system flagged the danger 2 weeks earlier. And he ignored it. He ignored a machine that was right. Because he trusted his gut more than the data. Let that sit for a moment. Because that story is not about artificial intelligence. That story is about ego. That story is about the oldest, most expensive mistake in investing. Trusting your emotions more than your evidence. Now here is where it gets interesting. Right now, in this moment, 89% of all global trading volume is being touched by AI algorithms. 89, not 50, not 60, 89%. Machines are reading the news faster than any human can. Machines are scanning earnings calls for hesitation in a CEO's voice. Machines are executing trades in microseconds. While you are still deciding whether to open the app, and every financial news channel is telling you the same thing, the human investor is finished. A has won. You cannot compete. Go home. But here is what they are not telling you. The most dangerous investor in 2026 is not one who ignores AI. The most dangerous investor is one who lets AI, or fear of AI, make their decisions for them. That is a psychology problem, not a technology problem. And psychology problems have been solved before. 2,000 years ago, by a group of thinkers who had no idea what a stock market was, but understood human fear better than anyone alive today. Welcome to the Stoic Millionaire. This channel lives at the intersection of ancient Stoic philosophy and modern financial psychology. Because the research keeps pointing to the same truth. Wealth is not built by the most informed person in the room. It is built by the most disciplined. If you want to build that discipline, especially right now, when the world of investing is changing faster than ever, you are in the right place. Subscribe if you have not already. Share this video with someone who is currently afraid of what AI means for their money. Because that fear, left unchecked, will cost them far more than any algorithm ever could. Let us begin. Picture two investors, same city, same year, same starting capital, same market conditions. The first investor spends 6 hours a day watching financial news. He reads every report. He follows every analyst. He subscribes to 3 different AI trading tools. Every time the market moves, he moves. Every time an algorithm sends a signal, he acts. Every time a headline scares him, he rebalances. He is, by every visible measure, the most informed investor you could imagine. The second investor does something that looks almost reckless by comparison. She checks her portfolio once a quarter. She ignores the daily headlines. She does not own a single AI trading subscription. She invested in a simple, diversified index fund 15 years ago. She set up automatic monthly contributions. And then she essentially did nothing. Fast forward to today. The first investor has an impressive collection of screenshots showing the times his AI tools were right. He also has a portfolio that has barely kept pace with inflation. Because every time he acted on a signal, he introduced a new variable, his own judgment, his own fear, his own greed. The second investor, she retired last year, not because she was smarter, not because she had better tools, because she understood one principle that the first investor never fully grasped. In investing, activity is not the same as progress. And this is exactly where the Stoic philosophy cuts through the noise of 2026 like a blade. Marcus Aurelius was not a passive man. He commanded armies. He governed an empire. He made consequential decisions every single day of his adult life. And yet, in his private journals, writings he never intended anyone to read, he returned again and again to the same idea. The obstacle is not outside you. The obstacle is the response you choose. The first investor's obstacle was not the AI tools he was using. His obstacle was the belief that more action, more information, more reaction was the same as more results. It never is. It never was. And in an age where AI can give you infinite information and infinite signals at infinite speed, this truth has never been more important. Because here is what actually happened to that hedge fund manager. The AI flagged the risk. The human overrode it, and the loss was not the machine's fault. It was the very human, very ancient instinct to believe that our own judgment, in the moment, is more reliable than evidence. The Stoics called this pathos, unexamined emotion masquerading as rational thought, and it is costing investors everything. Right now. Today. In the most technologically advanced financial market in human history. Let us talk about what AI can actually do, because it is genuinely extraordinary. Right now, AI systems are reading company earnings transcripts and detecting tonal shifts in a CEO's voice that predict stock movement days before the numbers are public. They are processing news in over 100 languages simultaneously. They are executing trades in nanoseconds. They are backtesting thousands of strategies in the time it takes you to make a cup of coffee. A recent Harvard-led study found that AI can now predict 71% of active fund managers trading decisions before the managers make them. 71%. Let that number land. If an AI can predict what your fund manager is going to do before they do it, what does that mean for the value of human judgment? It means the old version of human judgment, gut instinct, pattern recognition, chart reading, analyst consensus, is genuinely threatened. Genuinely, not exaggerated, not clickbait, real. But here is what the data also shows. AI trading bots fail in exactly the conditions that matter most. When something genuinely new happens, something the AI has never seen in its training data, it breaks down. The CEO of one of the world's largest crypto trading platforms said this directly at a major conference in February of this year. AI models have never seen a massive single-day liquidation event. When it happens, they have no map. They have no frame of reference. They freeze. Or worse, they act on patterns that no longer apply. And who has to step in when the machine stops working? A human. But not just any human. A human who has not panicked. A human who has not already made 3 emotional decisions in the past 48 hours because they were watching the market every hour. A human with a clear head, a long-time horizon, and a philosophy that was built specifically to function under pressure. That is the Stoic investor. The Stoics had a concept they called amor fati, love of fate, not resignation, not passivity, but the active, deliberate choice to work with reality as it is, not as you wish it were. Applied to AI and investing, this looks like something very specific. You do not fight the AI. You do not ignore the AI. You understand what the AI is good at: speed, pattern recognition, data processing, emotionless execution, and you let it do those things. And then you focus on what the AI cannot do. AI cannot define your values. AI cannot set your time horizon. AI cannot decide how much risk is appropriate for your specific life. AI cannot stay calm when the model breaks. AI cannot exercise judgment when the situation is genuinely without precedent. Those are human functions. Those are Stoic functions. And in 2026, those functions are not becoming less valuable. They are becoming the only edge that a retail investor can reliably hold. Because if you are competing with AI on AI's terms, speed, volume, data, you will lose every time. But if you are playing a different game entirely, patience, discipline, long time horizon, low transaction costs, emotional stability, you are not competing with AI at all. You are doing something it cannot do. So what does this look like in practice? How do you build a financial life that is genuinely resilient in a world where AI is making 89% of trades? The first principle is what the Stoics called clarification of values. Before you invest a single dollar, you need to know what you are actually trying to accomplish. Not in abstract terms, in specific terms. What is the money for? When do you need it? What level of volatility can you genuinely tolerate? Not in theory, but at 2 in the morning when your portfolio is down 30%. AI cannot answer those questions for you. Nobody can. And without clear answers, every AI signal, every market alert, every piece of financial news becomes a potential reason to make an emotional decision. Write your answers down. Date them. Return to them every time the market moves in a way that scares you. The second principle is the separation of signal from noise. In 2026, the amount of financial information available to a retail investor is effectively infinite. AI tools, news feeds, social media, analyst reports, earnings calls, macro commentary. More information does not produce better decisions. The research is clear on this. Beyond a certain threshold, more information produces worse decisions. Because more information means more potential triggers for emotional reaction. The Stoic practice here is called selective attention. You decide in advance what information is relevant to your strategy. Everything else is noise, and you do not consume noise. Not because you are uninformed, because you are protected. The third principle is what investors call a pre-commitment strategy. The Stoics called it premeditatio malorum, the premeditation of difficulty. Before the market drops, you decide what you will do when it drops. You write it down. You share it with someone who will hold you to it. If the market drops 20%, you will not sell. If the market drops 40%, you will not sell. If AI algorithms cause a flash crash that wipes 30% of value in a single afternoon, you will not sell. Because you already decided, before the fear arrived. This is the single most powerful thing a retail investor can do in an AI-dominated market. AI systems can be programmed to sell at certain thresholds. They can be triggered by signals and patterns. They can be overwhelmed by events they have never modeled. But a human being with a pre-committed, written, value-based strategy is operating on a different timeline entirely. The machine is playing chess. The Stoic investor is playing a different game, one that measures success in decades, not milliseconds. The fourth principle is cost minimization. This one is simple and backed by overwhelming evidence. In a world where AI systems are processing markets at nanosecond speed, attempting to beat the market through active management is more expensive and more difficult than ever. The evidence for low-cost, passive, index-based investing has never been stronger. Keep your costs low. Keep your strategy simple. Keep your hands away from the controls. That last point is the Stoic contribution, the discipline to not act. The wisdom to recognize that in most moments, in most market conditions, doing nothing is the highest value decision available to you. That is not a passive philosophy. It is an extraordinarily active one. It requires more discipline than any trading algorithm ever will. Let us come back to our two investors. The first investor is still watching the screen, still subscribing to new tools, still reacting, still convinced that the next signal, the next algorithm, the next AI upgrade will finally give him the edge he has been chasing for 15 years. The second investor is on a long walk. Her contributions went in automatically this morning. She has not checked her portfolio since the last quarter. She is not ignoring the AI revolution. She has simply understood something about it that most people have not yet grasped. The AI revolution is not a threat to the patient, disciplined, value-based investor. It is a gift. Because as AI systems make markets more efficient, more fast-moving, and more reactive in the short term, they are simultaneously making the long game more valuable. When every institutional trader in the world is optimizing for the next millisecond, the investor who is optimizing for the next decade has no competition. None. The machines are not playing that game. Most human traders are not playing that game. The arena is almost empty. That is the Stoic investor's edge. And it is not going anywhere. In fact, the more sophisticated the AI becomes, the wider that edge grows. Seneca wrote something in the 1st century that reads like it was written for this exact moment. He said that most men are not living. They are merely busy. Replace the word men with investors, and you have the most accurate description of the modern retail investor I have ever encountered. Most investors are not building wealth. They are merely busy. Busy reacting to signals, busy monitoring alerts, busy consuming information, busy performing the activity of investing without achieving the outcome of it. The Stoic millionaire is not busy in that sense. The Stoic millionaire is building, quietly, consistently, without drama, without reacting to every machine-generated signal, without needing to beat the AI. Because they are not competing with the AI at all, they are doing something the AI was never designed to do. They are living with intention. They are choosing their values consciously. They are building a financial life that is attached to meaning, not just to returns. That cannot be coded. That cannot be automated. That cannot be disrupted by the next model update. So here is what I want you to take from this video. Not as an idea, as a practice. The next time you see a financial headline that frightens you, the next time an AI tool sends you a signal that says act now, the next time someone tells you that the machines have won and the human investor is obsolete, pause. Take one breath. Ask yourself one question. Does acting on this move me closer to my values? Or does it simply move me? Because motion and progress are not the same thing. They never were. And in a world of infinite AI-generated motion, the investor who can tell the difference is the most dangerous person in any market. If this video gave you something real, share it. Send it to someone who is currently afraid of what AI means for their financial future, because that fear is the only thing that can actually hurt them, not the machines. Subscribe to this channel. Every week, we go deeper into the philosophy and psychology of building lasting wealth, not by being the fastest, not by having the best tools, by being the most human. We will see you in the next one.